Have you ever wanted to grow your money? Do you dream of financial freedom? Learning about the stock market can help you achieve those goals. Investing in the stock market is one of the most powerful ways to build wealth over time. It may seem complicated at first, but don't worry. In this guide, I will explain the basics in a way that is easy to understand. You work hard for your money. Let your money work hard for you. Investing in the stock market allows your money to grow. This is even when you are not working. It's like having your money make more money. Over time, even small investments can grow significantly. Don't wait any longer. Start your journey to financial freedom today. Learning about the stock market is an investment in yourself. It gives you the power to control your financial future. You can make informed decisions about your money. No more relying on others. You can take charge of your own financial destiny. Imagine a giant marketplace. Instead of fruits and vegetables, companies are bought and sold. This is the stock market. When you buy stock, you buy a tiny piece of a company. These pieces are called shares. Companies sell shares to raise money. They use this money to grow their business. The stock market operates through exchanges like the NYSE and NASDAQ. These exchanges are like platforms. Buyers and sellers connect through these platforms. The New York Stock Exchange, NYSE, is the biggest stock exchange in the world. Many large and well-established companies list their shares on the NYSE. The NASDAQ is another major stock exchange. It is known for technology companies. Companies like Apple and Microsoft trade on the NASDAQ. When a company's stock performs well, its share price goes up. This means your investment grows. Now you know what the stock market is. Let's talk about how to buy stocks. The easiest way is through an online brokerage account. These accounts are like online bank accounts. They allow you to buy and sell stocks easily. Opening an account is simple. You just need to provide some basic information. Once you have an account, you can start buying stocks. You can choose individual stocks or invest in funds. Individual stocks are like owning a piece of a single company. Think Apple, Amazon, or Tesla. Investing in individual stocks can be exciting, but it also carries more risk. Make sure to do your research. Before investing in any stock, understand the company. What do they do? How are they performing? Look at their financial reports. These reports tell you how the company is doing financially. Don't want to pick individual stocks? No problem. You can invest in index funds or ETFs. These are like baskets of stocks. They track a specific market index. An index is like a group of similar stocks. For example, the S&P 500 index tracks 500 large US companies. Index funds and ETFs offer instant diversification. This means you are spreading your money across many stocks. This lowers your risk. When one stock goes down, others can balance it out. Investing in index funds and ETFs is a great option for beginners. They offer a simple way to invest in the stock market. It's like investing in the entire stock market at once. You don't need to be an expert to get started. Section 5. Looking deeper, fundamental analysis. Now let's talk about how to choose individual stocks. One way is through fundamental analysis. This means looking at the company's financials. Think of it like checking under the hood of a car before buying it. You want to make sure the company is in good financial health. Start by looking at the company's revenue. This is the money the company makes from its products or services. Is the revenue growing? That's a good sign. Next, look at the company's earnings. This is the profit the company makes after expenses. Higher earnings are always better. Finally, consider the company's debt. High levels of debt can be risky. Fundamental analysis takes time and effort, but it can help you make more informed investment decisions. Section 6. Charting the course, technical analysis. Another way to analyze stocks is through technical analysis. This involves studying charts and patterns. Technical analysts believe that history repeats itself. They use past price movements to predict future trends. They look for signals and indicators. These signals suggest whether a stock is likely to go up or down. Technical analysis can be complex. There are many different indicators and strategies. It's important to learn from reputable sources. Many online resources and courses can teach you the basics. Remember, technical analysis is not foolproof. The market can be unpredictable. Use technical analysis as one tool in your investment toolkit. Section 7. Don't put all your eggs in one basket, diversification. You've heard the saying, Don't put all your eggs in one basket. This is especially true in investing. Diversification means spreading your money across different investments. This reduces your risk. Imagine you invest all your money in one stock. If that stock goes down, you could lose a lot of money. But if you diversify, you are less affected by the performance of any single investment. Diversification is like having a safety net for your portfolio. There are many ways to diversify. You can invest in different asset classes. These include stocks, bonds, and real estate. You can also diversify within asset classes. For example, you can invest in stocks of different sizes and sectors. Diversification is key to long-term investment success. Section 8. Protecting your investments. Managing risk. Investing always involves some risk, but you can manage that risk. One way is to set stop-loss orders. A stop-loss order is like a safety net for your stocks. It automatically sells your stock if it falls below a certain price. This limits your potential losses. Another important aspect of risk management is avoiding emotional trading. It's easy to get caught up in the excitement of the market, but emotional decisions often lead to bad outcomes. Stick to your investment plan. Don't panic sell when the market dips. Remember, investing is a marathon, not a sprint. Section 9. The magic of compounding. Compounding is like magic for your money. It's the process of earning interest on your interest. Over time, compounding can turn small investments into significant sums. Imagine you invest $1,000 and earn a 10% return. The next year, you earn interest on $1,100 instead of $1,000. This snowball effect continues year after year. The earlier you start investing, the more time your money has to compound. Even small contributions can add up significantly over time. Compounding is a powerful force. It can help you achieve your financial goals faster. Section 10. Never stop learning. The stock market is constantly evolving. New trends and technologies emerge all the time. That's why it's essential to never stop learning. Stay informed about market news and trends. Read books and articles about investing. Consider taking online courses or attending seminars. There are countless resources available to help you expand your knowledge. Follow reputable financial news sources. Subscribe to investment newsletters. Join online communities of investors. Continuous learning is crucial for staying ahead in the stock market. It allows you to adapt your strategies and make informed decisions. Section 11. Start your investing journey. Congratulations! You now have a basic understanding of how to make money from the stock market. Remember, investing is a journey, not a get-rich-quick scheme. It takes time, patience, and discipline. Start small and gradually increase your investments over time. Don't be afraid to ask for help. Consult with a financial advisor if you need guidance. Investing in the stock market can be rewarding. It can help you achieve your financial dreams. Start your investing journey today.